So when we think what has really just absolutely outperformed, guys, it's pretty clear that we are late expansion in the business cycle. Welcome back, YouTube, to the Financially Fit channel, the channel designed to put you on the right side of your trade or investment. Today is going to be a very deep dive into the 11 sectors. And before I even get into it, guys, type in down below what you think the top sector is going to be over the last 12 months. Whether that's going to be real estate, technology, healthcare, energy, materials, consumer discretion, utilities, consumer staples, telecommunication. Type it in the comments down below. Let me know who you think has outperformed over the last 12 months. These are the SPDR ETFs. They're all SPDR ETFs. First, what we're looking at right now is a 5-year chart of the 11 sectors and figure out where we are in the business cycle to break it down to the correct sectors we should be invested in. And with those sectors, we can pick individual stocks that should outperform the S&P 500. First thing I want to point out, guys, no matter what sector you're in, when there is a pullback, there's almost no place to hide, as we can see here, and as we can see here during the pandemic. There's just absolutely nowhere to go when you get a massive market pullback or crash. So everything in sympathy usually comes down at some point. Things come down more than others, but as we can see over the last 5 years, this blue line is technology absolutely leading the way by a large margin. So let's start with the worst performers. By the way, if you're new to the channel, you know what to do. Like and subscribe, smash that thumbs up. And if you find this information valuable, maybe share it with somebody you know that is interested in investing. The worst performer over the last 12 months is going to be XLP, which is going to be your consumer staples. That is up roughly 9.9% on the year. When we look at what the XLP is made of, the holdings that are in the XLP, it's going to be overweight Procter & Gamble, Coca-Cola, Pepsi-Cola. So these guys, these are basically your more of your defensive stocks. Procter & Gamble is going to be what you consider a non-cyclical stock. So they sell things we need on a daily basis. Along with that is Colgate. So these are definitely more defensive. You can argue the fact that no matter what happens in the economy, people have to grocery shop. So your Walmarts and Costco are also going to fit in that as well. So this is definitely a boring sector, a sector where this is where you want to be invested in if there is a market crash or we go through a depression, because these still should perform well in those markets. Directly behind your consumer staples is going to be utilities, a 10.5% return and a 2.88% yield. And their top holdings is going to be, the top 10 holdings are going to be Net Era Energy with 17%, Duke Energy with 8%, Southern Co with 7%, and Dominion Energy with 6.5%. So obviously all your energy companies have been laggers in the market along with your consumer staples. At number 9 is going to be XLC. And XLC is going to be communications, telecommunications. That has been up 16.8% on the year, and that also yields about a 0.5% yield. Is made up of Facebook, Alphabet, Netflix, Charter Communication, Comcast, T-Mobile, the Walt Disney Co., AT&T, and Verizon. So pretty interesting portfolio. Actually, I like this one a lot. And the fact that it's an underperformer, if we got a huge market dip, I would be interested in this one. So it has some really strong holdings with Facebook, Alphabet, Netflix, and then you also have a lot of defensive stuff in here with Verizon and AT&T, who pay a pretty decent dividend. So overall, interesting communication sector. Overall, I like it, and it has been an underperformer at 16.8% or 16.87%. This one caught me a little off guard here. The next sector is going to be healthcare. That has given you an 18% return on the year and yields about a 1.4% dividend. That company is made up of, that ETF is made up of Johnson & Johnson, United Health Group, Pfizer, Abbott, AbbVie, Thermo, Merck & Co. So pretty nice diversity when it comes down to the healthcare sector. A lot of great names in there and a lot of names that pay a pretty good dividend. So very solid company, pretty good returns on the year at almost 18% and yielding a decent little dividend as well. At number 7, we have materials. The XLB is the ticker symbol for this ETF or this fund, for this spider fund. Almost a 23% return with over a 1.5% dividend. Very, very nice overall, guys. Very nice return, very solid overall return on this fund, and you got a nice dividend as well. Top holdings in this fund is Lynn Sherman-Williams, Air Products, Freeport, Ecolab, Newmont. Absolutely great performance out of this portfolio as well. At number 6 is going to be Consumer Discretion Spider Fund XLY. It has given a 31% return, pays about a 0.5% yield. And the top holdings in this one going to be Amazon, Tesla, Home Depot, Nike, McDonald's, Lowe's, Starbucks, Target. Very, very nice fund, guys. This might be one of my favorite ones overall. A lot of these stocks have outperformed, and Amazon definitely has some more upside to it. Tesla's just been an absolute monster. You have some stability and recession-proof companies with companies like McDonald's, Lowe's, Target. At number five, this one surprised me a little bit, guys. It's actually the technology sector. I mean, over the last 5 years, it's been an absolute monster, but this year it still yielded 31.5% and pays over a 0.5% dividend as well. So nice perk owning that. And the top holdings in this one, obviously, guys, it's very overweight Apple, Microsoft, but then right underneath it, you have some pretty solid companies in NVIDIA, Visa, PayPal, MasterCard, and Adobe. At number 4 is going to be real estate. The real estate fund for Spider, XLRE is the ticker, has performed 37.2% year to date and has a 3% yield. Not really much more you can say about that, just solid all the way around. Solid yield, beating the S&P 500, and then the returns are extremely strong. Let's see who the top holdings are in this fund. Equinix, Public Storage, and then Simon Properties is one I've been looking at. But it's a little, in my opinion, it's a little overpriced right now, but that was one I was definitely looking at to own as a stock. So overall, guys, great performance out of this one with American Tower Corp holding the largest percentage. At number 3, barely beating out real estate, is going to be the financials. XLF is the fund. It has done 37.7% year to date, and it has over a 1.5% yield. So pretty solid overall, guys. Let's see what the top holdings are in this one. Berkshire Hathaway leading the way with JP Morgan, Bank of America, Wells Fargo, Citigroup, Morgan Stanley. Out of those bunch, I really like Morgan Stanley the best out of the banks. Guys, I feel like a jerk. I missed one, so let me back up really quick, and we're going to go back to number 5. At number 5 was technology. At number 4 was actually transportation, which we're going to go over now. At number 3 was real estate, and at number 2 was financials. So number 1 is coming up, but we need to go over transportation as I missed that one. It's kind of a boring one, and it actually was a great performer, so let's go over it. Year to date, it has a 36% return with a 1.18% yield, so not too shabby there, pretty much in line with the S&P 500. Some of the names in this one is going to be Lyft, U-Haul, UPS, FedEx, which has been a pretty good performer, Uber. So interesting stock, interesting fund here as it's pretty well diversified. They're not overweight in really anything. And some interesting names in here, guys. So for the number 1 performer, I'm sure you guys have figured it out. It is going to be Energy XLE, almost a 58% year return on this one, guys. Almost a 4% yield. I mean, what else can you say? This has been a monster of a performer, just an absolute monster, getting over a 50% return and a 4% yield on your money. Pretty friggin' strong. And obviously, guys, energy has been a lagger over the last 5 years, so it coming up this year would just make sense, as the leaders are going to be ExxonMobil, Chevron, ConocoPhillips, EOG. Now that we understand what the fund's performances are and what is technically in these funds, we can understand maybe where we are better in the business cycle, and I'm going to show you why this is extremely important. So when we think what has really just absolutely outperformed, guys, it's pretty clear that we are late expansion in the business cycle. It's pretty clear to me that we are late expansion in this cycle, guys. Very, very clear to me, as energy was absolutely a monster with almost 58% gains. Consumer staples had 31% gains. Financials were right there with them with 37, almost 38% gains. Healthcare with 18% gains. Materials with almost 23% gains, and real estate with 37% gains. Guys, this is clear to me. This is exactly where we are right now. And what does that mean? We are late expansion, possibly recession. I'm not trying to scare anybody, but we don't necessarily have to be recession. We could be basically at a peak of a cycle where you can go through a recession and maybe even a depression, which would be much lower than this. So oddly enough, guys, the ones that have underperformed, and what is giving me more confidence into going maybe overweight this, is the fact that utilities has only been up 10%, consumer staples, more your non-cyclical consumer staples is up 9.9%. Healthcare seems like it still has some room left to go. So very interesting, guys, that I think we are late in this cycle. We could be heading into a recession, as the indicators are telling me that those stocks that have underperformed could be the ones that you might want to go heavy into in 2022, as if we do get a massive pullback, and the fact that they've been underperformers is more confirmation that we are late in a cycle here. Now, within those funds, I would be looking for individual stocks in these sectors that have been underperformers, that have clean balance sheets and more upside to them. So certain consumer staple stocks I think are going to do extremely well, along with certain healthcare stocks as well, that have clean balance sheets and strong revenue growth. Along with that, I would be looking at real estate. I would be looking at REITs that deal with residential properties, and here is why. Rents are increasing drastically, over 10%. We are in an ultra low interest rate environment. So in my opinion, some of the residential REITs are going to do extremely well, as they can refinance a lot of these properties, pull cash out for lower interest rates, put more cash on their balance sheet, lower their cost, and raise rents. So interesting enough, if we got a pullback in any of the REITs, residential REITs, I would be interested in some of these, as I do think over the next few years they will outperform, as inflation is getting out of control. So guys, this is just my opinion. Hopefully you enjoyed my dive into where I think we are in the business cycle and what sectors I believe could outperform going forward. As always, I appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.